I don't know that this is going to cooperate with this here. How about now? Is the sound working? Got it to sound now. So I don't think this is set up here ultimately the best way for what we were wanting to do. You can hear us. We look a little goofy, I'm sure, here with the skinny video to try to get both of us on. But so let's start over now that everybody missed that entire bit. So Mitch, tell us a little bit about you, your background, how you got here. And
Great, thank you. So I have lived in Colorado for the last 26 years. I've got a wife and 3 lovely daughters, and have been in mortgage banking for the 26-year period, and have seen the city and community grow quite a bit over those 26 years, which has been fantastic to be a part of. And one of the things that I enjoy most about what we do is help people get into homes and buy their first piece of real estate or investment property, or even refinance an existing loan to save a lot of money each month.
Yeah, fantastic. So 26 years, been here almost as long as I am. I'm one of the few Colorado natives, but it sure changed a lot, hasn't it?
It has. The city of Denver and the communities surrounding have grown quite a bit, and it's been a fantastic thing to see, and see how many people have come into town, how many corporations have come into town, and how the opportunities have grown quite a bit for everybody.
Yeah.
Which has made it such a draw for people to come here.
Very cool.
Yeah.
And outside of mortgages in the real estate industry, what do you do for fun?
Well, I'm an avid tennis player, and I play 2 to 3 times a week. Keeps my mind off of all the things we do every day in life from a work professional standpoint. I have 3 lovely daughters who love to cook, and as I mentioned, I like to eat. So I learned about a lot of different new foods, and it's been quite fun to test out new items each week. And enjoy hanging out with my wife and just being together.
Yeah, excellent. Well, as we looked at a topic here to discuss, what's relevant, and one of the big topics that's in the news everywhere right now is what's going on with the politics. Now, this is not a pro one side, pro the other side. That's not what this conversation's about. What this conversation is about is what typically happens to mortgages during an election year and some other things that affect it. So I'm really curious, every year historically, or not every year, but each election year historically, what do you typically see interest rates do?
Right, that's a good question. It's a very big question. Excuse me. So typically in an election year, we tend to see the government keep mortgage rates and all interest rates as low as possible. They want to keep the economy strong, and they want to keep it moving forward, and by having low borrowing rates to do that, that impacts the economy on a favorable standpoint. So corporations can borrow money and expand and grow, as well as people buying homes, because mortgage rates are at lower levels, and it becomes more affordable. Okay. One of the things that could take place are the geopolitical events that are not political in any way, but it's just things that are outside our control, such as the recent virus that has come up. That has really scared the marketplace as far as economics go, which then in turn has caused mortgage rates to decline. And it is unfortunate that it's happening, but it has given some people the ability to borrow money at a lower cost.
Yeah, so we really are in a global economy, and everything that we are experiencing, everything that we have is not isolated, right? This is not us on an island. What's happening right now in China with the coronavirus is affecting interest rates.
Correct. And you would never think it could, but it does.
Yeah.
Yep.
So how much have they been dropping since this is going on?
They've declined almost 0.3%, which is quite a bit of money in relative speaking. If you took a $500,000 home loan, that would be about $150 per month, which is equivalent to $25,000 in borrowing power.
Wow.
That has happened over the last 3 or 4 days. Yeah. So quite impactful.
Yeah, huge. So other than some of the geopolitical, the stuff going on obviously in China, what are some other factors that really affect mortgage interest rates?
Another good question, because that does bring us back home to the U.S. So the typical items that are used and looked at were things like unemployment. So as unemployment becomes greater or less, that has a direct impact on the interest rate environment, and it eventually does trickle down into the mortgage rates. The capacity that corporations are utilizing their people and the ability to put out their products, as that gets better, then that causes inflation, and what that causes mortgage rates to go up. And so our goal is to see a very even keel of a very strong balance, which is what the federal government tries to do. But as we see inflation go up, you tend to see rates go up, and as you see deflation or the need to spawn the economy on, we'll see mortgage rates come down so that people will borrow again at a lower cost.
So it's really a stimulation to get people doing one thing or another, right? Borrowing more money, getting loans.
Correct.
So I've been hearing a lot that the unemployment's really low.
Mm-hmm.
So what is that doing ultimately for interest rates right now? Are they going up or are they going down?
Well, traditionally, low unemployment causes rates to go up. However, what's happening now is rates have gone down, and that's because of these external environmental pressures that have caused mortgage rates to go down, such as the geopolitical events, an election year coming up, and many other factors that we could talk about another time, but those things are causing it. So it's actually a really good marriage right now to have really low unemployment or high employment and low mortgage rates, because people can afford to go buy homes. And that's a great combination.
So a lot of people have jobs, and then the interest rates are low, so that creates a lot of opportunity for people to buy homes.
Correct. And affordability is even better at that point.
Which is ultimately one of the factors impacting what we're seeing here in the Denver metro area, which is low inventory.
Mm-hmm.
A lot of people have jobs, the interest rates are low, not a lot of inventory because a lot of people are becoming first-time home buyers. A lot of people are buying homes.
Yes. So the demand is there, and then you have the conversation about supply and demand of housing and what that does to the cost of housing.
Yeah, and definitely a conversation that should be had at another point, right? Just what's happening in supply and demand, what's going on with the inventory levels. Talk to me about seasonality. Now, I get asked a question about seasonality. When's the best time to sell our home, or when's the best time to buy a home? What's seasonality as it relates to mortgage rates?
Yeah, it's actually a question I also get every day. And so typically, there are times of the year when information comes out about the economy, and those dates stay consistent all the time. So some people say, well, in the summertime it's so busy that probably rates are going to be higher, or in the wintertime things tend to slow down, so mortgage rates should be lower. Well, right now that's true. We are in the wintertime. There was less activity, and mortgage rates have come down. However, those are from other external factors that had nothing to do with the traditional information that comes out.
Okay.
So to answer your question, the seasonality doesn't really matter when it comes to mortgage rates. It's when information comes out about the economy and the government, about the statistics that they track. And it's always the same every year, so we always know exactly what to expect.
Yeah, very cool. So talk to me a little bit about inflation, right?
Mm-hmm.
With what's happening, inflation going up, inflation being low, how does that impact mortgages and mortgage rates?
Sure. So there's different versions of inflation. The ones that impact mortgage rates right now have been at a place where they're very, very low and very flat. And we have not seen inflation for many, many years. We can go back to the Obama presidency. There was very little inflation at that time. And so what's happened is we've seen mortgage rates stay at a relatively low level. They've been as low as 3.25% at their lowest levels, and as high as 4.25% to 5% at their highest levels in the last 10 years. That is not a very large spread in that long of time.
Yeah.
So inflation, from a mortgage rate standpoint, has stayed very low, which has been great.
Yeah. So what about the correlation of the supply, the inventory of homes? We talked a little bit about that. What are we seeing both nationally and then locally in that correlation between there's not a lot of homes on the market, what does that do with rates, or there's a ton of homes on the market?
So it kind of goes back to supply and demand, and oftentimes when you have a lot of people buying homes, which causes a greater demand and less supply, we tend to see the demand for mortgages go up as well, which then causes our industry to keep the interest rates kind of at a level state. They don't really need to drop them any further because there's plenty of people wanting to buy and borrow funds if they need to purchase a home. So what the impact is, though, is we see the values of homes increasing, possibly because there's so many people wanting to buy fewer homes. And then you have offers that come in over asking price, then someone else will offer another price over that asking price, and you see the value of the property going up, which then causes the cost of borrowing the money to go up, and then the payments are higher.
Yeah.
But from a mortgage rate standpoint, we don't tend to see that being impacted as much as the value of the property that goes up.
Yeah.
So hopefully what that does show is a strong residential marketplace here for real estate, which is really what we always want to see.
Well, a good, strong, stable economy, I think, is positive for just about everybody.
Yes, very much so. And we have that. And we have seen the state of Colorado grow immensely with people coming into town with well-paying jobs, with new demand, new growth, and it's continuing. And I don't foresee any type of drop coming in the next several years of where we're going to see either a real estate bubble like we all experienced at some point in time 10 years ago.
Yeah.
We're not in the same place from 10 years ago. And the mortgage banking arena is not at the same place 10 years ago. We're making very good, solid loans for people who qualify, not for people who maybe should have thought twice about buying a home.
Yeah. Well, and I think everybody should have the opportunity to be a homeowner. There's absolutely some people that shouldn't own a home. Not stable with their finances. They're not secure enough to be able to have that kind of ownership. Not a knock on them. Everybody should have that opportunity, but
Sure.
As it turns out, not everybody should be a homeowner, as would be contrary to what the political arena was many years ago there in the 90s with the big push there that kind of led to that.
That's correct.
And I love that you brought up just kind of the economy there in Colorado. We tend to have a very diverse economy between farm and agriculture, oil and gas, technology, small business, construction. So we tend to have a much more stable economy than other places around the country that maybe are stuck to one industry or another.
That's correct. And that's also what makes our community so wonderful and diverse right now. And we are seeing people come here from so many different states for so many different reasons. Employment being the largest one, but sometimes just quality of life and being in the outdoors and everything that the state of Colorado has to offer, which has been going on for years and years, which is the main reason I came here 26 years ago.
Yeah.
So I don't foresee that changing, and I think it will continue to see the growth and not any kind of fall off by any means.
Yeah, I think the secret's out that Colorado is a really great place to live. Now, for a lot of the people that I knew growing up with, the natives, they may not like that the secret's out. Unfortunately, it is what it is, and until people start moving out of Colorado, that it isn't going to go very far. So, taking a look here at the impact rates have on the overall cost of ownership.
Mm-hmm.
So, what does that look like?
Well, we've seen rates be low for so long that the affordability has still been great, even as property values have escalated over the last 10 years. However, a good rule of thumb to keep in mind is as mortgage rates remain low, every $10,000 that you would borrow is equivalent to a $50 a month house payment.
Okay.
And so somebody's buying a $500,000 home at $50 a month, that's a $2,500 payment. Pretty reasonable. And if rates go up or down 1%, we might see that vary a little bit, but it's not a dramatic change whatsoever. So I think that with rates being where they are, it's going to continue to keep things very affordable and within line with what people want to spend for their housing expense. One of the things I like to also share is what we've seen over the last 10 years are buyers buying under what they qualify for, so they don't put themselves in a position of not being able to afford their home. And I think a lot of people have learned from 10 years ago that wasn't the right decision to make, and it's to overspend for what you could actually afford.
Yeah, just because you can afford it technically on paper doesn't mean that you can afford it in reality.
That's correct. Exactly. Exactly. So it's nice to see that people are being cognizant of their finances right now. Yep.
And I've always been told that 1% in the interest rate equates to about 10% of the purchase of the home, or 10% of the value of the home.
Mm-hmm.
So right now, on average, the average detached home in the Denver metro area is over $500,000. So we're really looking at a $50,000 plus reduction in the value if interest rates were to go up 1%.
Correct. And that's a big number. It's a real big number. So the hope is interest rates will remain where they're at, and we'll see the affordability stay the same, even if rates should, or if property values should go up a little bit. and interest rates stay the same, it still becomes an affordable house payment.
Yeah.
Yes.
So, if we look at, a lot of folks, and I'm kind of in this boat, right? I just bought a house. I love it. I don't want to move. So I'm not looking to sell my house. I'm not looking to buy another house right at the moment. So what about us, right? What about us that are happy where we're at as it comes to refinancing? If I bought my house, say in 2009, as interest rates were, around 5%?
Correct.
What might I be looking at, or what might be the advantage for me to look at actually refinancing my house today?
That's a great question, because we're having a lot of people contact us today and yesterday for looking to refinance. If you have an interest rate roughly about anywhere from 5% or even 4.5%, with the market right now running about 3.625 to 3.5%, you can save quite a bit of money on a monthly payment, or you can even pull some money out if you should want to do home improvements or pay off other high balance debt. But the savings, for example, on a $500,000 property or a mortgage of $500,000, 1% is $5,000 a year. That's $420 a month. That's a lot of extra money.
Yeah.
And the cost of refinancing is a couple $1,000s, so you can offset that fairly quickly. So it does pay to look to refinance if you do have an interest rate at 4.5% or higher right now, for sure.
Yeah, and if I bought my house 10 years ago, I'm 10 years in, well, what if I don't want to go back to a 30-year and start all over? What does that look like? Can I still save money?
You can save money in two different ways. So one, if you go to a shorter term loan, so there are 20-year loans, 25-year loans, 15-year loans, and 10-year loans. And so let's say you said I want to go to a 20-year loan or a 15-year loan, the interest rate will be a little bit lower. And then the money you may not save as much on your monthly payments, but what you will save is over the life of the loan. So if you were to save 9 years worth of payments at $2,000 a month, that's a significant amount of money over a 9-year period.
Yeah.
And so we help people with a calculation to determine what's the best option to look at from a standpoint of saving money. Is it important to save it on a monthly cash flow basis, or is it important to save over the life of the loan?
So it's not a one-size-fits-all, really. You're looking at each individual situation. What is their goal, and does it make sense to refinance?
Correct.
Yeah.
Yep, very, very much so. And some people now are refinancing to pull cash out to buy investment properties, which is another great opportunity to leverage your current asset that has a lot of value that's sitting there not earning any additional money other than great appreciation, that they can take and purchase another property for a rental purpose.
Yeah, I've got a good friend of mine. His name's Matt. He did that as well with his house that he bought in the Highlands. Ended up purchasing a fourplex with that after a cash out refinance. But what if I didn't buy it 10 years ago? What if I bought it last year? And I bought last year. So if I bought my house last year and interest rates were roughly about 4.5%, what about refinancing so soon?
Well, it could still make sense, depending on if you were paying mortgage insurance a year ago, if you had an FHA mortgage where you could refinance out into a conventional loan to eliminate or reduce the cost of mortgage insurance, or if you said, hey, I want to bring some extra cash to the table to help reduce my loan so I can eliminate mortgage insurance or just have a lower payment. So there are other variety of ways that it may make sense to consider, even 12 months from buying your home 12 months ago.
Yeah.
Yeah, so it's worth, again, if you're at a rate of 4.5% or higher, there still could be a significant savings, for sure.
Yeah, and that was the situation my wife and I are in when we bought our house last year. We were at 4.25%. Rates dropped. Looked at refinancing. We bought a new build, so just kind of the timing of it with when we locked in our rate, and our payment dropped about $300. Even though we've refinanced about 3 months after we had closed, it still made that big of a difference.
Mm-hmm. Yep,
So,
and it could, and then there you have your closing costs, but those also can be absorbed either into your loan or by the lender to help cover those closing costs.
yeah. So if it doesn't cost a whole lot, you can save a bunch of money.
And it's a win-win.
Absolutely worth
sure.
the conversation. So if you're in that boat, right, give Mitch a call, give me a call. We'll connect you with Mitch. Just looking at refinancing. So, you sent a graph, and I really like the graphs that you sent. And if you're watching the video, I'm going to be connecting and tagging in those graphs that Mitch had sent into the Facebook thread. But this was one from Freddie Mac that actually was showing the growth from 2018 October to 2019 October, and every state in the U.S. saw an increase in values. But more of my question was, who or what is Freddie Mac? What is that? What does that mean? And
Sure.
why do we care?
Certainly, it's a great question too. I get that also. So there's actually two conventional type of home loans that are supported by quasi-government agencies. One's called Freddie Mac. It's called the Federal Home Loan Mortgage Corporation. That's the acronym for Freddie Mac. There's also Fannie Mae, which is the Federal National Mortgage Association. Most people know Fannie Mae because it's most widely talked about. Those are entities that do two things. Ultimately, they'll buy the mortgage after the mortgage is closed with mortgage companies, credit unions, large banking institutions to get them off their lines of credit, off their books, and they're sold off, and then the lender gets their money back to continue to fund new loans. Fannie Mae and Freddie Mac create the guidelines that we all follow to help people become qualified for utilizing the best home loan that's available, which are Fannie Mae or Freddie Mac mortgages. And so we are closely tied to monitoring their guidelines as they change. Oftentimes, which they just did recently, they just increased their loan limits for people. So as property values escalate, they increase their loan amounts that you can borrow and put to the advantage of putting a smaller down payment. So they are our guideline, our map to how we put a loan together and follow those parameters to make sure that their clients can get the very best loan possible. So they're instrumental. Without them, the mortgage arena would be completely different.
Yeah, as banks and lending institutions really aren't lending their own money, so to speak. They're lending under these guidelines that end up being sold back to mortgage-backed securities.
Correct.
Right?
Yep,
I think
that's correct.
we heard that with the movie The Big Short.
Yes, very much so. Great movie. Always good to revisit as a reminder that making good home loans and making good financial decisions is a good thing.
Yeah. Yeah, so, if you've got questions specifically about mortgages, connect with somebody like Mitch, Mitch, you've been doing this a long time. You went through the downturn, but you care about the people that come to you. So you're not just putting them into a program to get them into a house to get a commission check. You're having a conversation about their goals and ultimately how to get them into the best setup for them.
That's correct. And that's the most important thing. The last thing we want them to do is to wake up in the morning. It's the first of the month. They have to make their mortgage payment and say, we really shouldn't have done this. We can't afford it.
Yeah.
That's not who we are, and that's not how we represent helping people with their financing.
Yeah. So another thing here that I want to talk about is just what the cost of waiting could end up being, right? So waiting to buy a home versus buying it today, and what that looks like. So the average detached home price is now about $518, and attached is up to $372. Yeah, those are real numbers here for Denver. It's getting more and more expensive. And roughly the growth that we had last year over the year before equated to about $26,000 on average for a detached home and about $31,000 for an attached property. So interest rates had actually declined over that time. So we saw that increase, interest rates dropped. That ultimately didn't affect affordability that much when you actually run the numbers.
That's correct. And that's the beauty of financing, is as values increase or you borrow a little bit more money and mortgage rates decline, the bottom line number as far as the total monthly payment did not change. Very, very small, less than 1/10 of 1%. So even though that's happened, it's still the same cost of buying that home 1 or 2 or 3 years later.
Yeah.
And so that's why we're all hopeful of keeping mortgage rates down. We have many different opportunities to look at different programs for people to help keep their rates down, even though they feel home values have gone up so much that it's out of their reach. And in fact, it may not be if they're looking at the right mortgage products for their needs.
Yeah.
So.
Well, what I found interesting about that stat when I take a look at it, and I'm a numbers geek, I like geeking out on numbers, the interest rates dropped from about 4.5 to about 3.7, roughly, right? So with 3/4 of a point in the drop, that made up for the appreciation. But as we talked about the cost of waiting, if we continue to see the appreciation this year, which supply and demand is indicating we're going to, there's just not enough homes to come up with the demand right now. Are we going to see 3/4 of a point drop again in interest rates to keep it even keel for buying, or what's your crystal ball vision for this?
Well,
Are we going to see interest rates continue to drop lower?
So over the years I've been doing this, I've seen cycles, and I don't think we're going to see a cycle of a downturn to that extent. That would actually be not favorable for the economy, so I'm hopeful that isn't going to happen. That means things have changed quite a bit from where they currently are, and too low of rates is not favorable. Too high rates is not favorable either, and right now I think we're in a very good sweet spot of lower rates, affordable payments, and property values still appreciating. So I feel the downside to waiting would be if you have appreciation and your mortgage rates stay about the same, you're gaining tremendously on the appreciation, you're gaining on some of your tax deductions that you get to take for your mortgage interest, and you carry an asset that you've leveraged. You've put $50,000 into a $500,000 asset, but you're getting a return on your $500,000, not on your $50,000. So the leverage impact is fantastic that you can't find in any other type of investment that's available to most of us who can afford to buy property.
Yeah.
So
that waiting a year between this year 2020 and 2021, if the rates stay about the same, let's hope that they do over the course of this year, and the values continue to go up, it may actually cost $31,000 or more to actually wait to buy next year versus doing it this year.
Correct, which could increase your payment by $200 a month as well.
Yeah.
And that's a real big number.
And $200 a month for some people, as they're on that line, that can make the difference between getting approved to buy the home that they want and not getting approved at all.
That's correct. Yep. So I always say now is the time, unless there's something obvious that says now is not the time.
Yep.
And we don't have anything obvious saying that right now. We haven't for the last 10, 12 years.
Yeah.
So look back 10 years ago in the house you thought you may have wanted to look at and see where it is today. Therein lies the proof.
Yeah, taking a look at some of the people that I know that bought 10 years ago and what they paid for their house and then what it's worth today, there's a lot of equity there.
There is.
Some of them are cashing out and leaving Denver. That happens. It's more rare. It is still happening, but there's a lot of equity there in the homes. So a couple of things that I want to touch on here before we wrap this up. One is rental vacancy rates are incredibly low. We're under 5% at about 4.7 for rental vacancies. And the rental rates are actually up almost 3% over the previous year. So the average rent right now in the Denver metro area is about $1,500 a month. So that's the average. Now keep in mind, you're going to have some that are way over that and you're going to have some that are slightly under that. That's just what happens with averages. But if I was renting an average home in the Denver metro area, paying $1,500 a month, what could I probably afford with minimal down, right? If I'm renting, it's likely that I may not have a giant stockpile of money that I just sold a house and have a big down payment. So about how much home could I afford if I'm paying an average rent right now?
Well, to keep your monthly mortgage payment about $1,500 a month, excuse me, and a smaller down payment, which would be anywhere from 3 to 3.5% down payment of the purchase price, you're looking at somewhere about $280,000 to $285,000 as a price to keep your payment at that level. And many people I speak with who are either paying at that amount of rent, the $1,500. Oftentimes are paying even more than $1,500. I know that's the average, but the reality is it's hard to even find a $1,500 property anymore. They're spending upwards to $2,000 to $2,500 a month in rent for a 2-bedroom, 1-bathroom apartment.
Right.
And that raises that bar quite a bit to be able to get into more average homes here in Denver. But yes, even at $1,500, you could buy a place for $285,000, which do exist, and they're out there to be considered if you want to buy a house.
And I think with the amount of people that are moving to Colorado, the 4.7 vacancy rate for the properties, there's a reason those are sitting vacant. They are not desirable places to live, or they're charging way too much for the rent, which is another disaster. So really taking that step into buying. And I know right now there's not a wealth of options at the almost $300,000 mark. There's still plenty of options. But really an opportunity to bring some stability to what it is that I'm doing with my daily budget, right? With how I'm living my life and building equity. I have debt pay down, I have appreciation. There's a lot of factors that come into that to where even paying $1,500 and $1,500, I'm coming out ahead financially owning my home.
Correct, very much so. And there's many other pieces of the puzzle outside of the financial side of it as well. Especially if you have a family, or you want to raise a family, the pride of ownership, the things you can do within your home to make it special and yours, and the community you move into of other homeowners. So there's a lot of variables that really impact everything when it comes to home ownership that we don't always think about.
Well, and I always looked at it, if I'm renting, I'm still paying a mortgage. It's just somebody else's mortgage, and they're getting all of the benefit that I'm paying for that. So.
That's correct also.
And last, we did get a question leading up to this, which really wasn't around topic of what happens during the election year, which what we found is basically the rents typically stay the same. What we've seen for homes sold, the number of homes, the number of transactions, that maintains still very much the same. We don't tend to see a big drop off for homes, the number of homes sold. But the question was, if I'm getting ready to buy a home and my mortgage or my credit is kind of borderline, are there some small, simple things that I could do maybe to bump that? Now, I'm gonna start this with the disclaimer that you're not a credit consultant. So that's not what your official role is, but you look at credit for a living.
Mm-hmm.
So are there some small things people could do to maybe give that a bump?
Yes, and it's actually a very, very wonderful question because it ties right into homeownership, and it is a direct correlation to how good of an interest rate will you obtain based on your credit history. And so the credit will impact two things. One, your mortgage rate. Two, the cost of your homeowner's insurance should you become a homeowner. And a lot of people don't know the impact on homeowners insurance as well. From a standpoint of what are some things you can take into consideration to help get yourself positioned properly or as best as possible with credit, one is run a credit report on yourself. See what's on there, make sure it's accurate, and see what it is. If it's inaccurate, then you can take the steps to contacting those creditors to find out why they're reporting you late, or why they're reporting some small open collection accounts, which we see a lot of medical collection accounts.
Yeah.
And we see people have accounts on their record that weren't even theirs. And so there's a lot of crossover when it comes if you have a similar name to somebody else, or a family member where you're a junior or senior and you have the exact same name as your father or your son. Looking at your credit report as often as you can do it once a year for free. There's several sites you can go to for that. And then contacting someone like myself who could say, let me review what you've just pulled and give you some feedback of what your credit report looks like and how we can best position you. If it's small cleanup of a couple of open medical collections, which we see a lot of, those are very minimal impact from as far as being able to qualify to buy a home. So those are smaller, but things like late payments that are recent, filing a bankruptcy, having a previous home that you own that unfortunately may have gone into foreclosure. So those are things that can be worked on, but those are more time, you have to be further away in time from when those items took place. So the simplest items are things like either some miscellaneous late payments or smaller collection accounts that we can be very instrumental in saying, here's what we think you can do to help get positioned in a better place to increase your score.
Yeah.
So they're not very difficult, actually.
Well, that's huge, and there's so much misinformation on the credit reports oftentimes that it'll show a late payment where there never was a late payment before. I know personally I had a Best Buy credit card that they said was months late. That was on my credit report that I had to fight for months and months and months just to try to get it off. Thankfully, I ended up getting it worked out after I continued to escalate the problem. Yet that's something that comes up. The credit bureaus, it's a business, so there's some things that you need to be paying attention to there. So as we wrap up, is there anything else that you want to touch on as we finish up?
Yes, I think if anybody has thought about wanting to buy a home and exploring the possibilities, speaking with somebody like yourself or myself is the best thing you can do, because a lot of people who want to speak with us might feel hesitant for many different reasons, and there's never ever any judgment made on having a conversation about how can I buy a home, and if I can't buy a home today, can you help me position myself to be able to buy a home sometime down the line, down the road at some point in time. And those conversations are extremely liberating, because people walk away thinking that they had to have 20% for a down payment, for example.
Yeah.
And you could have no down payment, you could have 3% down payment. So all of a sudden their door has opened up to really explore the opportunity and possibility of home ownership. So I think being educated and not being afraid to ask the questions is probably the best advice I could give to somebody who has any thoughts about wanting to buy a home at some point in time.
Yeah, what I've found is that ultimately with mortgage lending, right, and then a lot of other things in particular, there's a lot of creative things that can be done. So if you're not sure, if you're curious about something, what I've found is there's a lot of people out there that are just problem solvers by nature, and they're happy to come up with the solutions and help create that opportunity for you. So Mitch, I really want to say thank you for this. This has been hugely valuable. I hope it's been valuable for you guys as well. And I really appreciate those that chimed in, said that the sound wasn't working. We'll get this figured out for the future videos, what I need to do. Again, not the tech person, but we'll get that figured out. I know some great tech people that can help out. And for future videos, and I know Mitch is committing to several of these, so there's several things that he's wanting to do to come on these videos to bring value to you. But if there's anything specific that you want to know, you're curious about, whether that's buying investment properties, if that's, inspections, appraisals, what about, my credit report, connecting in with a credit repair counselor, right? Some of those things. Let me know. Shoot me a text, shoot me an email, reply back on Facebook, let me know. If you want to connect with Mitch, reach out to me and I'll get you connected directly to him so that he can answer some questions. And again, I'm always here for you for whatever it is that you need. Don't hesitate to reach out. I want to be the source of good information for you. So, cool.
Yep.
Awesome.
Wonderful. Thank you very much.
Thanks, everyone.
Spending some time.